given these account balances for some company at a point in time, what must their expenses be? Okay, let's write out the accounting equation. The assets of a company, of any company in the entire world at any point in time, all of the value of its assets are divided up. Who has claim to those assets? Well, that would be the creditors, or the people that the company owes money to, all of its liabilities, plus the owners of the company. Naturally, who else? Other than the owners of the company and the people that the company owe money to, that's who has claim to those assets, right? Plus equity. Okay, so this company has $46,800 worth of assets. The company owes $16,340 to creditors. So if the company goes out of business, sells off all of these assets, and now it has a pile of cash of $46,800 worth of cash, it first needs to pay off all of these creditors, and then the rest it has for itself, which is what equity means. It divides that remaining amount up between the owners. So owner's equity, how is that represented? Okay, remember, equity is broken down into common stock and retained earnings. So common stock, to date, there has been $30,230 worth of external money contributed to the company. The remaining value that the owners state claim to is the retained earnings, which, as the business runs its operations, it generates value, it generates cash. Well, the owners claim that cash, not the liabilities. So what is retained earnings, right? It's just the net income, revenues minus expenses, and then also you subtract from that how much the owners decided to take out and pay themselves, aka the dividends if you're talking about a corporation. So you first subtract out the dividends. They took out of the business $5,500 to pay themselves. And they generated through operations out of thin air more equity, which is accounted for as they had $11,450 worth of revenues, and they had to pay out X dollars worth of expenses. Let's crunch some numbers. So there we go. During this period, this particular company had $5,720 worth of expenses. At the end of a recent year, National Cleaning Service, a full-service house and office cleaning service, had total assets of $6,180 and equity of $3,940. How much were National Cleaning Service's liabilities? So let's write out the accounting equation. Assets, so everything that this company owns or has control of, all of those assets are accounted for, or the entities that can claim these assets or the liabilities of this company, and then the owners themselves, the equity. So okay, it's telling us here that National Cleaning Service has $6,180 worth of assets, so cleaning supplies, equipment, trucks. Okay, and all of that value is claimed by we don't know the liability, so how much money the cleaning service owes to creditors, but we do know that the owners of the business have put in, or they can claim $3,940 worth of these assets. So solve for X, and you find that the total liabilities, the total liabilities of the total amount of money that National Cleaning Service owes to creditors is $2,240. Answer A. Consider the overall effects on Jefferson Cleaning Service from selling and performing services on account for $6,700. So on account, meaning they weren't paid cash yet, but there's a promise that they'll be paid by the customer in the future, but they performed the services, and paying expenses totaling $3,300. What is Jefferson Cleaning Service's net income or net loss? So they performed $6,700 worth of cleaning services while incurring expenses totaling $3,300. So their net income, they earned a net income of $3,400. Answer C. For the following situation with regard to common stock and dividends of a corporation, compute the amount of net income or net loss during June of 2016. The company issued $15,000 worth of common stock and paid no dividends during this month. So, okay, on May 31st, 2016, so at the start of June, the company had total assets of $144,000 and total liabilities of $133,000. So all of the company's property that it uses to run the business, all of its things of value, it really, a lot of creditors had claim to that. The owners only had $11,000 worth of equity at this point. 144 minus 133. 1 month later, at June 30th, the company all of a sudden has $287,000 worth of assets, but their liabilities only went up to $144,000. So 287 minus 144 is $143,000. So at June 30th, the company all of a sudden, there's $143,000 worth of owner's equity. In 1 month, we went from $11,000 to $143,000. That's a $132,000 equity increase in 1 month. So where did that come from? $132,000 worth of owner's equity in June could have come from only two places, right? Owner's equity, there's only two categories. It's either going to be common stock or retained earnings. If you start your own business, what parts of that business can you say that's mine? Well, whatever parts have to do with the amount of money you yourself put in from your own bank account, common stock, or however you ran the business and you generated all these profits, that's yours too, retained earnings. So during this period, the company received $15,000 worth of external contributions, either in the form of cash or equipment, etc. And in exchange, the company gave out shares of ownership. But still, though, there's a big discrepancy here. Where did the rest of this equity that was generated in June come from? Well, it must have come from profits generated. So retained earnings is this fancy sounding word. It's just profits generated. Subtract out how much money the owners took out to pay themselves. So how much did they take out to pay themselves? Zero. There were no dividends. Plus, okay, what was the net income? Well, the net income is revenues minus expenses during a period, but this question doesn't want those specifics of revenues and expenses. It just wants to know in general, what was the net income or net loss? Well, it's going to be a net income here because we've got a lot of equity to make up for in the equation. Okay, so let's crunch some numbers and solve for X. So during June, the company had $117,000 worth of net income. So that's a big month. Maybe it's a water park or something. Before I move on to the next question, I want to note though, you could have approached this problem in a different way. Depending on your tutor or professor, they might look at it differently. All that really matters is that you have the theory of the accounting equation fully down packed in your head. So you could say, instead of what was the owner's equity at this point in time, you could say, well, look at this. During the month of June, the total assets increased from 144,000 to 287,000. So 287 minus 144, the company during this month gained $143,000 worth of assets. And during the month of June, their liabilities increased from 133 to 144. Their liabilities increased by 11,000. So you could take it from this angle. During June, if assets increased by this much, liabilities increased by this much, then equity must have increased by this amount minus this amount, $132,000, and then just go into, okay, how do we account? Where did this equity come from? And do what we just did.